Right now, the entire global economy is being completely rewired by the unprecedented race to build artificial intelligence. This chart shows NVIDIA's exponential revenue growth. By fiscal year 2026, driven by surging enterprise demand for their new AI chips, that number reached $215.9 billion. Simultaneously, Microsoft's cloud division surpassed $168 billion in revenue as organizations aggressively adopt the infrastructure required to run these tools. For investors willing to participate in this technological arms race, the market is currently generating wealth at a staggering pace. Yet the architect of one of the most successful investment records in history is intentionally sitting this out. Despite holding billions in cash, Warren Buffett is completely ignoring the AI boom. By his own admission in a recent CNBC interview, Buffett acknowledges he is late to the game. He notes that he struggles to understand modern devices, frankly stating he wouldn't be any good at navigating the sector. This raises a clear question. Is this avoidance simply the blind spot of an aging investor? Or is it a calculated maneuver by a master who sees hidden risks the rest of the market is ignoring? The answer lies in a foundational philosophy at Berkshire Hathaway, heavily shaped by Berkshire's late partner, Charlie Munger, the circle of competence. Their framework dictates that long-term financial survival relies less on the assets you aggressively accumulate and more on the opportunities you systematically and intentionally decline. Buffett frequently draws a parallel to baseball legend Ted Williams. Williams mapped his strike zone into 77 distinct segments and maximized his batting average by refusing to swing unless the ball crossed a tiny, specific happy zone. The complex, underlying mechanics of artificial intelligence and the software sector as a whole fall entirely outside of Buffett and Munger's defined zone. By rigidly adhering to this circle, they remove the temptation to chase hype. This strict discipline is exactly how they have historically avoided catastrophic losses in these highly volatile technology cycles. But there is a deeper structural reason Buffett avoids this specific boom: the relentless capital expenditure required just to stay relevant. He compares the current AI infrastructure race to building a railroad. The tech giants are forced to lay out hundreds of billions of dollars in continuous cash just to build the tracks. The industry's leaders, of course, defend this spending. They argue that this massive outlay is a mandatory cost of entry for a game they are currently dominating. Looking at this financial comparison, Microsoft has managed to sustain a 69. They insist that future shareholder value depends entirely on this heavy reinvestment. Yet, from Berkshire's perspective, these companies are locked in a cash-burning arms race. That dynamic stands in direct opposition to their ideal investment model. Berkshire's ultimate goal is to buy what they call moats, businesses with such predictable economics that they generate excess cash year after year without needing constant, massive reinvestment. Coca-Cola is the classic example of this moat. It is a dominant global franchise that requires almost zero reinvention to maintain its high returns on capital over multiple decades. This is even why Buffett holds a massive stake in Apple. He doesn't view it as a speculative technology company, but rather as a deeply entrenched consumer brand with fiercely loyal customers. Enduring moats effortlessly protect and compound capital. Conversely, constant technological arms races actively consume cash and introduce ongoing risk. Buffett has long maintained a healthy skepticism of technology monopolies, operating on the premise that a wonderful business yesterday is always vulnerable tomorrow. He frequently points to the history of IBM. Even after surviving major antitrust divestments, their absolute dominance in the computing space eventually eroded as newer, better systems arrived to serve their clients. Artificial intelligence acts as an exponential disruptor. In this environment, no tech leader's moat is safe from being eclipsed by a faster, more capable model. In the technology sector, current success actually breeds future vulnerability. It is a constant existential risk that Buffett simply refuses to underwrite. This ideological standoff traces back to Benjamin Graham, Buffett's mentor. Graham taught that in the short run, the market acts strictly as a voting machine, driven by popularity, but over the long term, it operates as a weighing machine, meticulously measuring actual, enduring cash flow. If the AI infrastructure build-out eventually turns into a cash-bleeding commodity race, Buffett's disciplined focus on established moats will be vindicated. But if this new technology cements permanent, unassailable monopolies, the weighing machine may finally prove the Oracle of Omaha wrong.